Okay, guys, good afternoon. Welcome to my online session. In the last class, we introduced the behaviors of cost and what is contribution margin. I hope you guys have a good understanding of these two important aspects so that you could have a good understanding in this class. Well, as I said in the last class, today I'm going to introduce the CVP analysis, which stands for Cost Value Profit Analysis. So now that you have learned about the cost behaviors, let's see how the managers use information to make business decisions. So CVP analysis, cost volume profit analysis, is a planning tool that looks at the relationship among cost and volume and how they affect the profit. CVP is also sometimes referred to as cost volume price analysis because changes in sales prices also affect the profit. So again, I will use our example, Smartest Learning, to continue demonstrating this point. Well, CVP analysis assumes some of the following assumptions for the relevant range. First assumption, let's see, it is the price per unit does not change as volume changes. For example, Smartest Learning Company assumes that all tablets will sell for $500 each. Or in other words, the selling price of each unit does not change. Secondly, managers can classify each cost as variable, fixed, or mixed. Third, the only factor that affects total costs is a change in volume, which increases or decreases total variable and mixed cost. For example, Smartest Learning Company assumes the variable cost per tablet is $275. Or in other words, the variable cost per tablet does not change. Fourth, total fixed costs do not change. For example, Smartest Learning Company assumes the fixed cost is $13,500 per month. And lastly, the last assumption is there are no changes in inventory levels. For example, the Smartest Learning Company assumes the number of tablets produced equals the number of tablets sold. But in reality, that is, I mean, I'm not the last one. I mean, all of the in reality, most business do not perfectly meet these assumptions. But managers still prefer to use CVP analysis as a good approximation, even though it is not exact. So what is CVP analysis? Let's look at this graph. Well, let's look at this graph. In this graph, the blue line that starts from the origin point indicates sales revenue. Well, as you can see, this line has a positive and a constant slope. That means if the company doesn't sell any of the product, it earns zero profit. As the company sells more and more products, the revenue goes up. And in this graph, the orange line indicates the fixed cost. The orange line is constant at a more than $10,000 level. Well, actually, as I said, we assume that Smartest Learning Company assumes a fixed cost or $13,500. And obviously, the green line indicates the total cost, where the total cost here is a mixed cost. It has both variable and fixed cost natures. Because the total cost starts at $13,500 and it has a positive constant slope. And that slope indicates the variable cost of each tablet manufactured, which is $275. So there is a very interesting point in this graph. That is the intersection of the blue line and the green line. Or in other words, the intersection of sales revenue and total cost. This point is called break-even point. Well, a break-even point is the sales level at which the company doesn't earn a profit or a loss, but has an operating income of zero. In other words, at this level of sales, the company has an operating income equals to zero. Let's see. If the unit sold is below this point, the company would suffer a loss, which is the orange area in this graph, the loss area, the orange area. If the unit sold is beyond the break-even point, the company will earn an operating income while covering the fixed cost. So at this point, the required sales can be expressed as either the number of units or a total dollar figure. So our purpose is to know how much is the break-even point, either in dollar amount or in unit amount, the number of units. In this chapter, here I will introduce 3 methods to help you to get to know the break-even point. The first method, the first method, equation approach. An equation can be used to estimate the number of units a company needs to sell to achieve the target profits or total sales revenue. Well, the equation is right here. Net sales revenue minus total cost equals to operating income. And as I said, at break-even point, the operating income equals to 0. And we can further break down this equation to this form, because total cost, or the mixed cost, includes two parts, variable and fixed. So the total cost can be broken down into variable cost and fixed cost. So the general equation can be broken down into this form. Net sales revenue minus variable cost minus fixed cost equals to operating income, where operating income in the case of break-even point is 0. So now let's use this equation to get the break-even point. Total sales revenue equals to the selling price per unit times units sold. Variable cost equals to the variable cost per unit times units sold. And the fixed cost equals to $13,500. To get the break-even point, as I said, the target profit should be 0. So target profit is 0. So in this equation, the only unknown element is unit sold. By solving this equation, you can get the units sold equals to 60. So this is the first approach to get to know the break-even point. We know that at the sales level of 60 units, the company will achieve its break-even point. 60 units. Well, this is the first approach, equation approach. The second approach is contribution margin approach. The contribution margin approach is a shortcut method of computing the required sales in units. Previously, we proved our answer using the equation approach. We can rewrite the equation approach to be in this form. The equation approach can be rewritten to derive the following equation, this equation. Fixed cost plus target profits divided by contribution margin per unit equals to required sales in units, where target profit should be $0. So let's try to use this equation to get the break-even point. At break-even point, the required sales equals to fixed cost plus 0 divided by $225 per unit, where $225 is the contribution margin of each tablet. Well, if you can remember that the contribution margin equals to the selling price minus per unit cost. So we assumed that the selling price per each tablet is $500 and the variable cost per tablet is $275. So this is how we get the contribution margin per unit. 225 equals to $500, which is the selling price per unit, minus $275, which is the variable cost per unit. Okay, using contribution margin approach, we can get the same amount of units at the break-even point, 60 units. Well, let's see the third approach, which is contribution margin ratio approach. This slide illustrates how we can prove our answer using the contribution margin income statement format. Okay, last method, contribution margin approach. Companies can use the contribution margin ratio approach to compute the required sales in terms of sales dollars rather than in unit. The formula is the same as when using the contribution margin approach, except that the denominator is the contribution margin ratio rather than contribution margin per unit. Well, first of all, we should know the contribution margin ratio. It is 45%. Contribution margin divided by sales revenue, 45%. And in the next equation, we replace denominator from contribution margin to contribution margin ratio. So we use fixed cost plus target profit, which is $0, divided by 45%. We can get $30,000. So using this way, we can know the dollar amount in terms of break-even point. Or in other words, we know at break-even point, we should sell at least, we should get at least $30,000 to reach the break-even point. Okay, these are three approaches to get to know the break-even point level, either in terms of unit or in terms of dollar amount. A variation of the break-even point calculation is target profits calculation. Well, target profit is the operating income that results when net sales revenue minus variable and fixed cost equals management profits goal. The same three approaches can be used here. The only difference is that a company uses target profits instead of break-even points of 0. Okay. In this case, for example, the company requires a target profit to be $4,500. $4,500 instead of $0. So using this information, let's try to get to know the units, the number of units or the dollar amount of total revenue required to achieve this target. First, using equation approach. We can replace the target profit, zero target profit, from 0 to $4,500. So we can get the unknown element units sold to be 80 units. Using contribution margin approach, we can replace target profit here from $0 to $4,500. And using this way, we can also get the same result, 80 units. Using the last approach, contribution margin ratio approach, Same thing. We replace the target profit here from 0 to 45,000. We can get the targeted net sales revenue to be $40,000. Okay, again, this slide shows a cost volume profits graph, and it shows how changes in the level of sales will affect profits, as in the variable, fixed, and mixed cost graphs, and the volume of units on the horizontal axis and the dollar amount on the vertical axis. And again, the break-even point is the level of sales where operating income is 0. If the sales is below this point, the company will suffer a loss, which means the sales revenue is not able to cover the fixed cost. And if the sales revenue is beyond this point, it results in an operating income. Well, next, let's see how CVP analysis can be used to perform the sensitivity analysis. Okay, sensitivity analysis. Sensitivity analysis is a what-if technique that estimates profits or loss results if sales price, cost, volume, or underlying assumption changes. Typically, in sensitivity analysis, we will see the changes in sales price, in variable cost, and in fixed cost. We will see how these changes can, what effect can these changes bring to the sales revenue results. Well, first of all, let's see the changes in sales price. If competition of a particular product is fierce, the company may need to cut the sales price of its product to remain competitive. Assume the competition in the touchscreen tablet computer business is fierce. The smartest learning company believes it should lower the selling price from $500 to $475 per tablet to maintain the market's competition. So, in this case, let's see what effect will be resulted if the sales price changes from $500 to $475. Well, using the same equation, we can know the required sales in units increases from 70 units to from 60 units to 68 units. The equation is fixed cost plus target profit divided by contribution margin per unit. Well, in this case, we know the selling price changes from $500 to $475. So the denominator changes. Or in other words, the denominator decreases. So the final result should increase. Okay, let's look at this equation specifically. Previously, this part was $500. But here, in order to maintain the market share, the company should change the selling price from $500 to $475. So this part changes from $500 to $475. So the denominator decreases. Well, the actual result of this equation is 67.5 units. But this result should be rounded up to the next full unit because the company cannot sell half of the tablets. So we round up these results to 68 units. Well, this is the sensitivity analysis in changes in sales price. Next, let's see how do we use the sensitivity analysis to analyze the change in variable cost. Back to the Smart Touch Learning Company's original data. And let's disregard the change made in sales price in the previous example. Let's assume one of the company's suppliers raises the price, which increases the variable cost for each tablet to $285 per unit. So that results to a difference right here. From originally it was $275, but now because of the increase of the materials, it raises from 275 to 285. So let's see, in this case, what happens? In order to achieve the break-even point, we know the required sales units increases from 60 units to 63 units. And also, we should round up the result to the next full unit. Well, this is how do we use the sensitivity analysis to analyze the changes in variable cost. And lastly, let's see what happens if the fixed cost changes. Well, let's assume the Smart Touch Learning company's fixed cost increased from originally $13,500 to $1,605. What will this change result to the required sales in units to achieve the break-even point? Let's see. Well, in this case, the difference in equation is in this part. We know the fixed cost increases while the selling price and the variable cost remains the same. Because of the increase in the fixed cost, the result also increases from the original 60 units to 74 units. We know higher fixed costs increase the total contribution margin required to break-even point. And in this case, the required sales in units increases from 60 units to 74 units. Well, this slide shows how all these changes would affect the contribution margin per unit and the break-even point. Well, managers usually prefer a low break-even point to a higher one, but do not overemphasize this one aspect of CVP analysis. Even though Smart Touch Learning has a break-even point of 60 units, and each of the previous examples increased the break-even point, management wants to do more than break-even. So please consider these two scenarios. In scenario 2, please notice how much operating income increased compared to scenario 1 when the sales volume increased. The only difference between two scenarios is a difference in contribution margin. Please remember that contribution margin is the amount that contributes to covering the fixed cost and then providing operating income. In both scenarios, fixed costs are covered when the sales are 100 units. So in scenario 1, each increase in sales of 100 units increase operating income by $1,500. While in scenario 2, each increase in sales of 100 units increased operating income by $2,500. Management can use contribution margin to predict the changes in operating income when volume changes. In the short term, managers may not be able to reduce fixed costs to increase operating income, but they may be able to increase contribution margin. The two components of contribution margin are sales price and variable cost. So, an increase in contribution margin can be created by an increase in sales price per unit, or a decrease in variable cost per unit, or a combination of both. For example, as sales increase, managers hire more workers, which increase the variable cost of labor. However, when sales decrease, the managers may want to lay off some workers, especially if the sales decline is expected to be temporary, and instead find alternative activities for those workers. Therefore, the decrease in sales is greater than the proportionate decrease in cost. Managers need to be aware that their decisions, such as laying off the workers, may cause cost to behave differently than expected based on their CVP analysis. So this phenomenon is known as the cost stickiness. Well, that means cost increase more when sales volume is increasing than cost decrease when sales volume is decreasing. Cost stickiness. So, for example, in this slide, it illustrates an example of cost stickiness. You can see how the slope of total cost line does not decrease at the same rate when sales decrease as it increases when sales increases. It decreases or increases at different level or different slope in the graph. Okay, the last goal of this chapter. Let's see how to use CVP analysis to calculate margin of safety, operating leverage, and multi-product break-even point. Well, we have learned how CVP analysis can be used for estimating target profit and break-even points, as well as a sensitivity analysis. Now, let's look at 3 more applications of CVP analysis. They are margin of safety, operating leverage, and sales mix. Margin of safety is the excess of expected sales over break-even point. That's pretty much straightforward. Basically, that means how much more is the expected sales beyond break-even point. The more it is, the safer you are. Managers use this margin of safety to evaluate the risk of both current operations and their plans for the future. So let's apply this to Smart Touch Learning Company. Well, originally, these companies' break-even point was 60 tablets. Let's assume the company expects to sell 100 tablets. So the safety margin can be expressed in units, in dollars, or as a ratio. In units, the safety margin is calculated as expected sales minus break-even point, the sales level at break-even point. Well, in this case, we use the expected sales of 100 tablets minus 60 tablets at break-even point. We get 40 tablets. So the margin of safety expressed in terms of units is 40 tablets. The second way is to express margin of safety in terms of dollar amount. We can directly use 40 tablets times the selling price per tablet. We get $20,000. It is the margin of safety in dollar. And lastly, margin of safety can also be expressed in terms of ratio. We use margin of safety in units divided by the expected sales in units. 40 tablets divided by 100 tablets. We can get 40%. Well, this is margin of safety, which is pretty much straightforward. Basically, it means how much more is the expected sales than the sales in break-even point. Well, next, let's see operating leverage. The cost structure of a company is the proportion of fixed cost to variable cost. This relationship is important because depending on the cost structure, small changes in the business environment could have a substantial impact on profits. Companies with higher fixed costs are at greater risk, but they also have the opportunity for greater rewards. Let's compare two companies to see how their cost structure affect their profits when there is a change in sales revenue. Well, for company A, its operating leverage is 2.5, 2.50, where the operating leverage is calculated as the contribution margin divided by operating income. Okay, for company B, its operating leverage is 1.25. Well, let's assume that the selling price for company A is $5 per unit, and the selling price for company B is $15 per unit. So in the sales level of 500 units, both company A and company B have the same operating income. And well, let's assume that the fixed cost is different for each company. But at the different sales level, let's decrease the sales level from 500 units to 400 units. And the selling price remains at the constant for both companies. I mean, $5 for company A and $15 for company B. In this case, the operating income for company A becomes lower than that in company B. So why is that? Because the operating leverage for each different company is different. So basically, operating leverage predicts the effects fixed costs have on changes in operating income when sales revenue changes. And lastly, let's see how CVP analysis can be used to do analysis in sales mix. Well, most companies sell more than one product. Sales mix or product mix is the combination of products that make up total sales. The same CVP formulas we used earlier can apply to a company with multiple products. Sales price and variable cost differ from each product, so each product makes a different contribution to profit. To calculate the break-even points for the company, we must compute the weighted average contribution margin of all the company's products. The sales mix provides the weights that make up the total product sales. The weights equal 100% of total product cost. Well, let's use this example to illustrate this point. A furniture company sold 6,000 cat beds and 4,000 scratching posts during the last year. The sales mix of 6,000 beds and 4,000 posts creates a ratio of 6 to 4, or 3 to 2. So, in other words, for every 3 cat beds sold, the company expects to sell 2 scratching posts. So, this sales mix can be regarded as a package, which includes 5 items. 3 are cat beds and 2 are scratching posts. So, the first step to calculate the weighted average contribution margin per unit is like this. As I said, for each package, we can expect 5 items, and that package, the selling price for that package is $200. So for each unit, the weighted average contribution margin is $40. We use $200 divided by 5 units. Well, no matter what unit it is just 1 unit. Oh, next, we can calculate the break-even point in terms of units for the package of product. We use the fixed cost divided by the weighted average contribution margin per unit, which is calculated in the previous step, equals to $40 per unit. Well, we assume that the fixed cost of this company is $40,000 divided by $40 per unit. We can get 1,000 units in order to achieve the break-even point. So lastly, the last step is to calculate the break-even points in units for each product in sales mix package. We just multiply the package break-even points in units by each product's proportion of the sales price. Well, for the cat bath, we know its weight in each package is 60% or 3 over 5. So we use 1,000 units times 60%. We can get 600 units for cat bath. And similarly, we use 1,000 units times 40%, which is the weight of scratching posts in each package. We can get 400 scratching posts to be sold to achieve the break-even point. Well, this is the break-even points expressed in terms of unit. 600 cat baths plus 400 scratching posts. If you want to express the break-even points in terms of dollar amount, we continue multiplying the units in each different item to the selling price of each different item, where the cat bath is sold for $44 and the scratching post is sold for $100. So this is how we use the sales revenue to see what if the company is selling more than one product in order to achieve its break-even point. Okay, we can prove the break-even point by preparing a contribution margin income statement. If the sales mix changes, then the company can repeat this analysis using new sales mix information to find the break-even point for each product. In addition to finding the break-even point, it can also be used to estimate the sales needed to generate a certain level of operating profit. Let's assume that this company would like to earn the operating income of $20,000. In other words, its target profit, its new target profit is $20,000 instead of $0 at break-even point level. So the company would need to sell 1,500 units using the same calculation. The only difference is right here. We replace 0 to 20,000. We can get the new result to be 1,500 units. So using the same calculation, we can know the selling units for each different products for cat bath. Similarly, its weight is 60%. So we use 60% times 1,500. We can get 900 cat bath. And similarly, we use 1,500 units times 40%, which is the weight of scratching post. We can get 600 scratching post. So we can also prove the planned profit level by preparing a contribution margin income statement. In a nutshell, in order to achieve the target profit to be $20,000, 900 cat baths need to be sold. Additionally, another 600 scratching posts need to be sold. Well, this is the application of the CVS, not CVS, CVP analysis. CVP analysis. Well, that's all of these chapters. I understand that there are a lot of calculations in this chapter, but the essential thing is only one or two things. That is the three approaches to get to know the break-even point. If you can have a good understanding of these three approaches, you will have, I believe, you will have good understanding of its application. All right, everyone, please let me know if you have any more questions before I end the class.
Professor?
Yes?
How are you? What would you grade the homework that we did, the chapters assignment that we did?
You mean what?
No, when will you grade them?
Then when?
Yes.
Well, I set the due date for each chapters. Or
Okay,
you
no
can,
problem.
yes, or you can also refer to the syllabus.
No problem. Thank you.
Yes, you're welcome. Well, any more questions? If there's no more questions, I will see you next week. Bye-bye.